Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines this afternoon. The Nifty holds on to gains, trading above the 10,000 mark. Lupin leads the charts.
Adani Transmission hits upper circuit after the company says it's entered into exclusive talks to buy out Reliance Infrastructure's power business in Mumbai.
The US FDA issues a complete response letter to Biocon and Mylan on a biosimilar which is being jointly developed to treat cancer.
Meaningful capex recovery is at least 3 to 4 years away, says India Ratings, adds higher government spending is inadequate.
And Gujarat becomes the first state government to cut local taxes on petrol and diesel.
On the show, India Ratings believes the revival in India's capex cycle is some time away. We're going to be talking to the author of that report, Priyanka Poddar from India Ratings. Vinayak Chatterjee of Feedback Infra has the cure for India's beleaguered power sector. A slice of that conversation coming up in a bit.
We'll start with markets though first. And Pradeep Pandya is with us with all the equity market action. Big picture, Pradeep, and then we'll get into some interesting stuff.
So we are able to hold above 10,000. That's a positive, I'll say. But there is no action if you look at it, in indices. And what's really happening is, like I mentioned yesterday also, there's a lack of leadership when it comes to Nifty. So if you are a Nifty trader, you'll be disappointed because the stocks that are really moving up are from healthcare, IT. These are not the leading sectors. You would rather like, metal, auto, and banks to move up. They haven't got that kind of traction. So what are traders really doing? They are focusing on mid cap and small cap. Yesterday also we saw that although index didn't recover much, but the small cap index recovered quite a bit and finally trended up, close with a gain of 0.5% plus. Today as well, you can see mid cap and small cap continue to remain strong.
Okay.
Which means what traders or dealers suggest us is that mutual funds continue to be the net buyers, and therefore the flow continues to come into the market. Net liquidity is positive, and there is nothing negative, so to say, if you look at the global data, or there is no such negative news flow. So markets are just holding on. But action is definitely on the long side, and that is only in mid cap and small cap that we can say today.
Okay, hold the thought, Pradeep. I want to bring up one chart from the terminal on the screen just to give you a sense of what's going on. This is what CLSA is talking about. If I can bring up that. If I can bring up the chart on the screen for you, what you're seeing on the three lines, the white line is the valuation picture for the MSCI India Index. The blue line is the emerging market index, or the yellow line is the emerging market index, and the white line and the blue line is the world index. What CLSA is saying is that foreign inflows into India are unlikely to revive because they're not seeing any sort of revision of upgrade as far as earnings are concerned. The second point they're making is the fact that markets like China, Korea, Taiwan, you're seeing earnings revision upwards, and the stocks are less costlier. And therefore, you're going to perhaps, even if somebody's looking at an emerging market basket, money might go there as opposed to India. What does this do you think? If mutual fund money is tapering off, and if FIIs are not going to come back, have we hit the peaks for the year?
So first we talk about mutual fund. This morning we were talking to a fund manager, and what he clearly told Bloomberg Quint is that the net retention is now declining. So there is a consistent flow, but there is also redemption, and redemption has gone up relatively, at least by say 50% or so. So which means the net retention has come down from 75% to 60%. So that is one. And if you talk about the CLSA report itself that you just mentioned, CLSA believes that flows in Indian markets will remain weak, or there could be continuous net outflow because we are expensive and there is no growth to justify it. So unless after the results there is upgrades, which is unlikely, nobody is really projecting it, probably till the end of the year we'll remain in a range. So CLSA clearly concludes that we'll remain in a range. Indian markets are unlikely to give you very strong returns from the current level. And if I may add to that, there is another report that you saw which also says that Indian currency is also among some of the most expensive currencies. So that could be probably another reason why FIIs will probably see higher risk. Unless you have faith that macros are going to remain intact and Indian currency can actually remain strong, this is not a very good time to enter a market when a currency is overvalued.
All right, Pradeep, thanks so much for that. Various pulls and pressures on the market, and I think the one thing that has held them up so far has been the strong inflows. But the direction, as Pradeep was also alluding, whether it stays the same or whether there's a slight change in the direction of flows into mutual funds, is the question that everyone will be asking and tracking very closely. Jayesh has the latest data. Jayesh, there's some indication of a change in trend. Of course, it's 1 month, so early to call it a trend.
Yes, Ira. So if you look, there's a trend in the income segment that we are seeing on the mutual fund data. The data suggests that for the second month running, we have seen the total AUM managed by Indian mutual funds cross the 20 lakh crore mark. Now, if you look at the recent data that was released, the total AUM, it declined tad bit, just 1% to about 20.4 lakh crores. But where the good news came in was that the equity AUM jumped as much as 2.5% and is right now just over that 6.5 lakh crores. Like I was telling you, some pressure building up in the income segment, which saw a decline of about 5.5%, and the total AUM managed under the income segment is now just over 8 lakh crores. Now, if you look at the flow picture, this was the AUM. The flows suggest that once again there was an outflow of to the tune of about 16,500 crores. This was the first outflow that we saw after 2 consecutive months of inflows. Now, equity segment, once again, that was positive because it saw an net inflow of about 18,900 odd crores. And once again, the pressure can be seen in the income segment. So, which means that the redemption pressure that Pradeep was talking about, that was related to the debt segment, which saw an outflow of nearly 50,000 crores. Now, as far as the individual fund houses are concerned, we looked at the top 10 fund houses that are there in India. ICICI Prudential tops the charts. That saw in Q2 FY17, the AUM grew as much as 7.3%. But the real surprise came in with SBI, because that was the biggest gainer of all, where the AUM jumped about 11.3% for the total AUM. Now, the mutual funds which manage more than 50,000 crores, L&T was the surprise over there. L&T Mutual Fund, in fact, saw a net addition of about 18.5% to its AUM. Now, given all of these numbers, what did the market do in September? Well, Nifty was just down about 1.5% odd, and FIS sold more than 10,000 crores of equity, while the DIS pumped in more than 20,000 crores in equity.
Jayesh, thank you so much for that. That's an interesting observation of what's going on in the mutual fund space. We've been talking about how FIs have been selling in the last couple of months as well. But later on the show, a lot of stock-specific action today, be it Adani Transmission and Reliance Infra's exclusivity agreement, or Biocon, or Apex Frozen Foods, or Lupin, which is the top Nifty gainer of the day. We'll talk about it, all about that in a moment.
Let's kick it off with the first one in a move that could change the fortunes of the beleaguered Anil Dhirubhai Ambani Group. Adani Transmission has entered into exclusive talks to buy Reliance Infrastructure's Mumbai power operations. Jayesh is still with us and he's tracking that story too. Jayesh, this could be a potentially sort of transformative deal for both companies. Can you explain the details to us?
Yes, Ira, could be potentially game changer for both the companies. Now, we understand from the press release that Adani Transmission and Reliance Infra have got into an exclusive agreement wherein it lasts up until January 2018 for the Mumbai power business. Now, the proposal is that Adani Transmission is going to acquire the Mumbai power business from Reliance Infra. So, let's have a look at what's on offer. The Mumbai business, that is, what Adani Transmission will get, will be the generation, transmission and the distribution phase. So the entire business will go to Adani Transmission. Now, how will our infra use the proceeds? They have mentioned in their press release that all of the proceeds that will come in from this deal will be used to reduce the debt. Now, currently, as per FY17, the debt stands at more than 25,000 crores. So, it will be interesting to see what the contours of the deal are, because those are not available as of now. If you look at the financials of the company, like I was telling you, Reliance Infra has a debt of about 25,000 crores. Adani Transmission, how will that benefit? Is that they will get an entry into the power distribution business. Earlier, till now, they were only into the transmission phase, but with this deal, they'll also make an entry into the power distribution business. Now, we have understood that our infra has been willing to sell this or hive off this division from their business, recently, because if you look at even the Q1 FY17, Q4 or Q3, all the press releases during the results season, they have indicated that, they are looking, or they are rather in advanced stages to to hive off or to sell off this division. But these have all been unsuccessful attempts till now.
Jayesh, thank you for that. Biocon and its partner in the United States, Mylan, have gotten a new letter from the US FDA on a biosimilar that they've been working on. The complete response letter on the cancer drug means that the final approval is still pending. Darshan is standing by with some details. Darshan, now, does that in a sense affect or impact the commercial launch in any way?
See, the commercial launch was supposed to happen in probably end 2018 calendar year or you know, the first quarter 2019 calendar year. So the timelines the management says does not matter, but it's a clear case that, you know, the management, the note that came out by the management indicated the fact that a complete response letter has been given, not because there were issues with the drug, there were issues as far as the manufacturing facility is concerned of Biocon. And this is not the first time that, you know, Biocon has faced this. Even earlier, the bigger drug trastuzumab faced an issue and they had to delay the target action date by 6 months. This is the second time that, you know, for another drug, a target action date has been delayed. So it does not bode well for Biocon. In terms of timelines, yes, it does not alter because they have enough time. But it all depends on whether the FDA will clear this site or no, because the US FDA gave them 8 observations, the French authorities gave them 35 observations. So it will be very difficult for Biocon to clear this. Couple of reports that have come out, Haitong is rather negative. I was just reading a note that Morgan Stanley wrote, and it just came out, and they indicated the fact that, you know, the commercial timelines won't change. But the matter they believe is that, you know, the other filers also have gotten a complete response letter, and they believe that Biocon will be able to come out much ahead of the others on this entire deal, and that is why probably the stock may be up in trade despite negative news that has come out.
4% up in trade as of today, as of now. Thanks, Darshan, for that. That's Biocon for you. The other pharma stock, Lupin, which happens to be the top nifty gainer today, has had a rather rough ride otherwise this year. It's fallen nearly 30%. In fact, it's the worst performer in the S&P BS in the Sensex. But promoter entities, it seems to have made the most of this opportunity in hiking their stake in the company. They have bought shares worth nearly $3 billion over the last 6 months. That's according to data compiled by Bloomberg. But, you know, the street seems to be a little bullish about this counter despite this fall. That's Lupin for you.
Right, from core sectors of power to pharmaceutical to shrimp. Shrimp consumption the world over is growing rapidly, according to a report released by the United Nations. And that report and that newfound love for shrimp has got one company or one stock excited, and that is Apex Frozen Food. Sumit is joining us with the details on this. Sumit, what are you analyzing here? Why people love shrimp so much?
Let's see. We'll see why people love shrimp so much. Now, if you see, the stock has been on a tear. In the last 25 sessions, the value of the stock has nearly doubled, and since listing, it has gained more than 145% to its issue price of 175. Now, India was the largest exporter of shrimp in 2016, and according to the latest report of United Nations, shrimp seafood exports from India is expected to rise by another 41% in 2017. Now, Apex, who generates 100% of its revenue through exports, is catching up on the same by increasing its capacity by 20,000 million tons per annum. Now, speaking to the management, they said in the financial year 2019, when the new capacity will come in, the total capacity will be around 35,240 million tons per annum, and the utilization will be at 63%. And in financial year 2020, the utilization will rise to 77%. Now, this will boost company's revenue. Now, along with this, the management also said that they have a leased capacity of around 6,000 million tons per annum, which they might discontinue, which will aid the margins of the company. Now, if you see now in the another factor which also works in favor of this company is depreciating rupee. Now, being an exporter, depreciating rupee generates higher income for the company. Now, in the last 1 month, rupee has depreciated by 2.5%, and the non-deliverable forward market is factoring in another 4% drop in rupee value in the next 12 months. Now, analysts are also bullish about the company. Now, Now, ICICI Direct says that the new capacity can add a potential revenue of around 700 crore and can boost the company's return on capital employed to 48% versus the 29% as of now. Equirus Securities is expecting company's revenue and net profit to grow at a compounded annual growth rate of 25% and 45% over FY17 to FY20, and they are expecting the company's margins to expand by around 350 basis points, led by the savings coming in from discontinuing the lease capacity and lower procurement cost. Now, finally, coming to the valuations and peer comparison. When it comes to price to earnings ratio, the company is trading at a cheaper FY19 valuation compared to its listed peer, that is Waterbase, and when it comes to market cap to sales, it is trading at par with its peer, that is Waterbase.
Interesting. Capacity expansion, and the street is bullish on the stock and expecting the stock to move up as well. Soumya, thank you so much for that. Let's talk about capacity a bit. A recovery in India's capex cycle will remain elusive for at least the next 3 to 4 years. That's the main message coming in from a report put out by India Ratings. The credit rating agency says increased government spending is inadequate and it will fall back on the private sector to ramp it up for any meaningful uptick in capex. Joining us to discuss this is Priyanka Poddar, Senior Analyst at India Ratings. Priyanka, thank you so much for joining us on Bloomberg Quint. Let me begin by this conversation by asking you about what did you make of, how do you expect, you're actually saying that this is going to take until fiscal 20 for any meaningful recovery to happen. On what basis, on what are the factors that are you basing this argument?
The key driver that we think that will push the investment recovery beyond FY20 is the implementation of the insolvency and the bankruptcy code. Obviously, now there are pros and cons there. While this will help in the debt resolution of some of the stressed corporates, we think that the increased consolidation and the mergers and acquisition activity that is likely to happen in various sectors is likely to push back the investment cycle. While obviously the non-stressed corporates, having a higher capacity utilization, will be in a position to spend at that point in time, whereas these stressed corporates are likely to delay the overall recovery by another 2 years.
So when you differentiate between stressed and non-stressed corporates, how long do you expect each of them to, their revival cycles to revive, the revival to take place?
So if you look at the track record of the investment, this investment made by the non-stressed corporates, they had shown a degrowth of nearly 11 to 12% over the last 3 to 4 years. Whereas if you look at the capex spending of these non-stressed corporates, they have shown a trend of a recovery of say 10-11% in the capex. Now these are the non-stressed ones who have a capacity utilization of say 75-80%, and they are ready to kind of spend in the next 2 years when we think the demand situation is likely to improve. Whereas the non-stressed corporates who have a capacity, the stressed corporates who have a capacity utilization of 40% are likely to result in the non-stressed corporates to kind of push back the investment cycle because of the idle capacity that's there on the ground.
Your report also says that even if the investment demand picks up, you anticipate credit supply constraints. What could those funding constraints be?
If you look at the bank's structure currently, there's a lot of NPAs that is standing on their books. There is a higher recapitalization needs, and more and more banks, particularly the PSUs, are becoming highly risk averse. So obviously, given the expectation of a pickup in capex, probably these banks will not be in a position to fund them. And if you look at the data that we've taken out, it is by and large the AAA and the AA rated entities who will be kind of driving the investment cycle. And if that is the case, then probably the need for the investment is likely to go to the NBFC and the capital market space. Now the question that is whether these NBFCs and capital markets have a depth, in terms of or the size or the risk appetite to fund the large scale debt funded capex. So that we have to see.
So Priyanka, what about government spending? The rate of growth of government spending has declined. Why do you think that has happened? Can you explain what's going on there?
the data that we have seen by and large on an absolute basis, the government spending has been increasing YOY. But if you look at the growth rate in spending, that has decelerated, and it was nearly single digit over the last 2 to 3 years. Whereas even if you look at the government spending as a percentage of GDP, that is also kind of decelerated. Now with the government now tightening their fiscal purse and with their fiscal deficit target, it is unlikely that they will be in a position to kind of spend a significant amount that is going to drive the overall investment cycle.
Okay, I have one final question. So, this forecast that you've made, what could be the roadblocks to this investment revival?
Yeah, so we think that the three things, that if the capacity utilization of an overall industry remains at 60-65%, the leverage levels remain at 5x, which is kind of highest in the decade. And if we think that the consumption is not going to revive in a significant way, it's not that we think 2 years down the line investment will revive. It can even take a 6 to 7 years in the overall investment cycle revival.
We'll leave it there, Priyanka. Thank you so much indeed for joining us. Priyanka Poddar from India Ratings talking about investment revival. Fiscal 20, the onus back on the private sector. It all boils down to perhaps 100, 125 companies is what India Ratings claims.
Yeah, let's see how that plays out. But the fact that it's so far away is a little bit worrying. Speaking of the core sector, the power sector continues to be a trouble spot, and weak discoms are still holding India's power sector hostage. That's the word coming in from Vinayak Chatterjee, chairman at Feedback Ventures, who spoke to Bloomberg Quint earlier today. Chatterjee continues to argue that the only lasting solution for the power sector is to privatize the distribution segment. He also argues that in some of the newer power segments, that is renewable power, you need to move away from irrational pricing, which often gets brought into the system if you go along with the lowest bid. Herein, to listen into a slice of that conversation.
The advantage with steel sector stressed assets is that the output of a steel plant can be sold in the open market. The fundamental problem with the power sector is that the tail wags the dog, in a sense that the sector, in my view, and I've been saying this openly, is being held ransom by the clutch of 45 plus state-owned discoms. When I mean state, I mean the federal state structure. It is a sector which is being held hostage by the 30-40 years of sheer degradation of the functions and the standards and the governance of discoms. The entire sector is being held to ransom, whether it is coal or whether it is renewables. Now, unless the discom story is set right operationally and not financially. See, the Uday schemes attempted to set right the discom financially by providing a bit of financial relief. But the flip side of the coin is that they were mandated to reduce AT&C losses to 15% by 2019. I am not sure that's going to happen. So until something drastic is done to actually address in a surgical strike mode the distribution sector in this country, I am afraid the pessimism on the traditional power sector in terms of generators of power will continue to remain and continue to be stressed. So the million-dollar question is, what can you do to the distribution sector? There is a two-pronged attack which I have been advocating for a long time. One is that you have to really step on the gas on allowing private sector to run distribution circles. There are many models to do that, and I don't want to take the time of your audience to detail all of them. But get private sector into electricity distribution, period. Strategy number 2, set up a national power trading and distribution company. I have always been saying that India, the center, its power is a concurrent subject, and the center has always played a key role in fuels. For example, it owns coal. I mean, the central government owns interests in coal and other forms of energy. It plays a key role in generation through NTPC. It plays a key role in equipment through BHEL. It plays a key role in transmission through Power Grid. But when it comes to the distribution sector, it kind of throws up in hands and says it's a state subject. I don't think the Indian public is buying that anymore, or the time has passed to just take a back seat and say, oh, we are trying to persuade the states. It is time for the center to act. And the simple message we have, or the suggestion we have for the center, is immediately set up a national power procurement and distribution company, and this company fully funded, it should be funded to the extent of 50,000 to 100,000 crores, should pick up the power of all stranded assets. Whatever the state discoms can pick up, God bless them, let them pick it up. Whatever is left as unutilized capacity, The nation has many, many hours of blackouts and darknesses so many decades after independence. That is unsustainable, including Prime Minister's own vision of 24/7 power. How are we going to give 24/7 power? The stranded capacities, the unutilized capacities of all these power plants should be picked up by the National Power Company and then distributed to start with central government entities like railways, ports, airports, government buildings, anybody who wishes to buy the power.
Vinayak Chatterjee of Feedback Infra talking about some of the prescriptions needed to clean up the power sector. Meanwhile, the centre has imposed anti-dumping duty on imports of certain steel wire rods from China for 5 years. What does this mean for steel companies? Nikki Mirchandani is standing by with some of those details. Nikki, what do we know?
Sure. So, Centre has imposed anti-dumping duty on imports of both bars, rods, hot roll of iron or non-alloy steel. The duty has been imposed from all the imports coming in from China for a span of 5 years now. India has already slapped in an anti-dumping duty on certain cold rolled products, fat steel products. Now the brokerage MK take on this anti-dumping duty is it's sentimentally positive for long steel product manufacturers. Now this goes behind the making of long steel products, and SAIL, JSW and Tata Steel are some of the large cap companies that we have that manufacture long steel products. However, there seems to be no material impact of this development for on the financials of these companies, given that India just about imports overall 20% of long product in the basket of the overall steel products for that matter.
All right, Nikki, thanks so much for that. Gujarat has become the first state to cut local taxes on petrol and diesel. The cut comes just days after the central government decided to reduce excise duty on retail fuels. Prices will fall by more than 2 rupees per litre in the poll-bound state. Sajid Mangar joining us with the details. Sajid, I think the expectation or the hope is that other states will follow as well.
That's right. Last week we saw the central government reducing the excise by 2 rupees in petrol and diesel, and now we have seen the first state to take action, because before the poll announcement happens, all the announcement has to happen in Gujarat. So they have taken a decision to bring down the VAT by 4%, which is more than 2 rupees, which will be there. The second state which will be coming out with a reduction would be Maharashtra. Maharashtra has already said that they are looking at a VAT reduction for petrol and diesel, and that is expected today or by the end of today or something. We have at least 8 or 9 BJP states which will at least go for a VAT cut, so that the government can say that the prices have fallen by nearly 5 to 6 rupees or so. After the first round of central excise cut, the prices came down by 2 to 2.5 rupees, and based on the VAT cuts by various states, it will further come down. Again, crude has been marginally lower in the last few days, so that the prices will also be there. So it will all have an impact of nearly 5 to 6 rupees going forward. But the thing is that from now you will have all the BJP ruled states, Maharashtra or others, will coming out with gradual VAT cuts.
I don't know if this is an answer that you can give off the cuff. Is this a temporary move to sort of allay concerns, or does this seem like a policy directive towards lower taxes across the board?
Well, it's a follow-up to a public outrage which has happened for crude, because crude prices have fallen by more than half and prices have remained there, or in fact gone up from there, and the centre and the states have gone and increased VAT or the central excise duty over a period of last 3 years. Substantially. Means 5 to 6 rupees has been increased by the central government itself. You had Maharashtra coming and increasing the rates after after I think GST also they had increased rate by a rupee or two. So all those things are adding up to petrol prices in Mumbai at least reaching close to 80 rupees. Now it's around 77 rupees or so. But when Maharashtra cuts rate, it may bring down to 75. So it's more than reducing tax rates. Is more about a reaction to the public sentiment, saying that prices of fuel have gone up despite the fact that global prices are favorable to the central government.
I wonder what it does to the revenue shortfall and how they're going to make it up. But thanks Ajit for that. The government meanwhile is also working on overhauling the direct tax structure in the country. People in the know have told Bloomberg that the emphasis will be on simpler processes and a faster redressal. Shruti Srivastava of Bloomberg, who filed this report, joins with all the details. Shruti.
The government is planning to undertake a massive exercise to revamp the existing Income Tax Act, and our sources tell us that the new act will be up for public comments by early next year. Not only is the government looking at cutting down the multiplicity of forms, it is also planning to make this language much more simpler to encourage people to come and pay taxes. The government is working on simplifying the existing transfer provision rules, which have been a cause of concerns for foreign investors for some time in India now. Also, it is also planning to cut down the public interface which the taxpayer currently has with the income tax department. The inquiries now would be sent by income tax department to the taxpayers online. Similarly, in the new act, the taxpayer would also be given provisions to appeal online. Experts say that the current Income Tax Act is a patchwork at best, and if the government chooses to simplify it, it will help the foreign investors navigate through the complex provisions which are there in the Act right now.
All right, that's on the taxation side. Staying with some government news, the government may sell about 1 million tons of pulses to avoid its stockpiles rotting in warehouses. That would amount for about half of the total inventories. Rishi Benibal of Bloomberg News joining us on the phone line from Delhi with more. Rishi, I mean, it's a pity. We've gone through many cycles, but now we're in a position where we have to actually, sort of worry about excess pulses.
The government is likely to go for distress sale of about 1 million tons of pulses to avoid stockpiles rotting in warehouses. What we are picking up from our sources is that they are trying to sell the reserves in the open market and to some states as well as organizations like railways and defense forces. So most of these pulses have a shelf life of 9 to 12 months. They want to sell it before it nears the shelf life. As we know, India is the world's largest consumer of pulses, and this sale would amount to about half of the total inventories. The reserves we have, the stocks was built around last year to control surge in prices of pulses. Experts are telling us a sale just before the winter crop season will lower domestic prices and cut imports. So the idea is to sell it before it rots.
Rishi, we'll leave it there. Thank you so much indeed for joining us. Rishi Benibal from Bloomberg News talking about the situation with pulses. Out of time on the show. Thank you so much for joining us on lunch today.